Session 11 will be a presentation to begin with, followed by a panel discussion.
Welcoming
and to
our
lead us
speaker,
into
our
11th
panelists,
session,
and our moderator, ladies and gentlemen,
please join me now in welcoming our moderator for Session 11, Dr. Timothy Ong, the Chairman, Asia Inc. Forum.
Ladies and gentlemen, welcome to Session 11 on the future of emerging markets. Where are the next economic miracles? Where are the next breakout nations? This is an important discussion because the emerging markets comprise some of the most important economies in the world. They include the BRIC or BRIC economies, Brazil, Russia, India, and China. In the Pricewaterhouse, the PwC survey, when APEC CEOs were asked which are the economies to watch in the next 5 to 10 years, they identified 11 economies, of which 9 were emerging economies. So this is an important discussion, especially at this time when there are indications that all is not well in the emerging world. There are signs of a slowdown in most of the major emerging markets, including in China. So the question of where we go from here, what is happening to the emerging markets, is an important question. This session will proceed in the following way. We will begin with a presentation by Ruchir Sharma, investor, author of the best-selling book, Breakout Nations, In Search of the Next Economic Miracles, and part-time sprinter. Following Ruchir Sharma's presentation, we will have an open forum discussion led by 3 distinguished discussion leaders. Ibu Karen Agustiawan, who is the CEO and President of Pertamina. Under her leadership, Pertamina, as most of you know, recently became the first Indonesian company to join the Global 500 list of major companies. Ibu Karen will be joined on stage by Kevin Liu of the World Bank, and a close observer of developments in China. And they will be joined on stage by Pierre Gignac, who is the President and Chief Executive of Export Development Canada. So we will have a lively discussion involving different perspectives on this important subject of emerging markets. This discussion will be open to the floor. So if you have questions in the course of the discussion, please indicate that you have a question, and we will try as best as we can to include you in this discussion. But welcome to Session 11 on emerging markets. And now I would like to invite Ruchir Sharma to deliver his presentation, following which we will have our open forum discussion. Thank you.
Great, thank you very much, everyone. The fascinating thing about following global macroeconomic trends is that they are so impermanent, which is, I was thinking to myself as I was preparing this presentation, that had I been invited a decade ago to speak on this topic, I would have said exactly the opposite. So that's why I've always said that a rule that I have for myself is that never make very long-term forecasts, because for one, neither you nor I'll be here to know whether we were right or wrong about those. And secondly, that as practitioners, they have very little practical value. So the time horizon that I try and look at how the world is shaping up or what the big trends are is typically about 5 to 10 years. Anything longer than that I find to be sort of almost irrelevant for most practitioners, whether it's investors, it's politicians, or business people. So with that in mind, I wrote the book, and I've prepared a presentation on the back of that in terms of which are the next breakout nations. But to put this in context, as you will see here, I find this quite fascinating, which is that every decade there is some theme which captures the imagination of the world. That theme leads to extraordinary returns, only for that theme to peter out in the subsequent decade. So the 1970s was all about the rise of commodity prices, natural resources, gold, oil, which all went up about 500 to 1,000%. And then for the next 2 decades, those were terrible investments. In the 1980s, it was about the meteoric rise of Japan. At the peak of the Japanese bubble in 1989, the Japanese stock market was 50% of global stock market capitalization. And since then, the Japanese stock market and the Japanese economy have been a real disappointment for 2 lost decades. The 1990s then saw the rise of technology as a major force. The NASDAQ came into being. TMT was what the acronym that we all spoke about for that decade. And then you got the big bubble which burst in the subsequent decade. Similarly, I think that last decade, what came to capture the imagination of the world was the rise of these brick economies. Last decade, every single developing country did well. And this has never happened before, in that never before had so many emerging markets risen in unison, in a synchronous manner. And that's what happened last decade. And the acronym which captured everyone's imagination was BRIC, because it featured the 4 largest emerging economies. But the fact was that every single emerging economy was doing well, and we had the rise in commodity prices on the back of this huge rise in these BRIC economies. But as you will see now, that what happens is that in every subsequent decade, these things just don't do that well. So as you can see that over the last few years, these BRIC stock markets, for one, have lost 40% of their value. And this is in keeping what we have seen in the last few decades, which is that what's hot one decade is rarely hot in the subsequent decade. And this is not happening for any random reason. It's happening because these economies, their growth rates are all slowing down. As you can see here, that on average, the economic growth rates of all these large economies has been cut down by half. In fact, the likes of Brazil, Russia, and South Africa are currently growing at only 2% a year, which is no different than the United States, and a very disappointing outcome given the fact that these economies have a per capita income level which is only a fraction of that of the United States. So the process of convergence between these economies and the United States has come to a halt. And even India and China's growth rates have slipped quite a bit, with India in particular disappointing with a growth rate of only 4.5% this year, which for an economy with a per capita income of only $1,500 is again a disappointing outcome. So what's exactly happening with these economies? So if we look at China, China's path today is very similar to where Japan was in the 1970s. China today is a middle-income country. It no longer is a young economy that can sprint at a very rapid pace. China's economy today has a per capita income of over $7,000, and this is exactly the level at which the Japanese economy in the 1970s downshifted to a much lower growth plane. The Japanese economy in the 1970s downshifted to a pace of about 5 to 6%, and I suspect that that's the best case scenario for China now, which is that its economic growth rate slips to levels of 5 to 6%. And I say best case because remember, Japan, Korea, Taiwan, the gold medalists of growth, these were the economies that were able to keep growing and go past middle income levels, whereas there are many other countries that at similar income levels hit the middle income trap and were never able to carry on the process of convergence. But hoping that all goes well for China, a 5 to 6% economic growth rate over the next 5 to 10 years on average is the best that we can expect out of China, as it now is a middle income country. China's main problem today is the fact that its debt levels are very high. A lot of people speak about debt without quite getting this concept very clearly. The point here is that debt is positively correlated to per capita income levels. The richer a country, the more debt it typically tends to have. And in China's case, as you can see, that for a country with a per capita income of $7,000, its debt to GDP ratio of over 200% is very high. It is in fact higher than what it should be for other countries in the middle income league. So in some ways, China's debt situation today, especially as a share of its overall economy, is more worrisome than the United States, even though the stock of debt in the United States is much higher, but so is the overall per capita income level and the wealth level. Just trying to get the slides going here. This, we think, has major implication for commodity prices. Now, in commodities have followed a very predictable history over the last 200 years in terms of commodity prices, which is the rule for commodity prices is 1 decade up and then 2 decades down. So therefore, the long-term return for commodities has been zero in inflation-adjusted terms. And after we got a great decade, last decade, where prices increased very sharply, we now expect a sharp slowdown in commodity prices. This is also because a whole new bunch of capacity is coming on stream on commodities. Just to put this in perspective, over the last few years, the increase in new capex in the energy and materials sector has been 600%. And the increase in capex of the other sectors has been 200%. So there's a massive buildup of new capacity in commodities, which is now coming on stream in both mining and in energy. At the same time, Chinese demand on an incremental basis for these commodities is slowing down. This does not bode well for countries such as Brazil. As you can see, as far as Brazil is concerned, Brazil's incremental growth rate has been very dependent on commodity prices. The typical rule for Brazil has been that its average economic growth has been 2% a year. When commodity prices do well, it gets up to 4-5%. When commodity prices are not doing too well, Brazil's growth rate comes to a near stall. Last year, Brazil's economy grew at only 1%. This year, it will do barely better than 2%. So the big Brazil economic dream seems to be behind us, and Brazil is reverting back to its history, where for decades it has remained locked in terms of its per capita income in relative basis versus the United States in a broad range. It really is in many ways the un-China, which is that the big difference between Brazil and China is this, that whereas China invests a lot in physical infrastructure, Brazil has amongst the worst physical infrastructure in the world. And so, therefore, in many ways, Brazil and China are the two opposites of each other. As you can see, that China has made a real success of its economic model because of the investments it makes. In Brazil's case, a lot of the spending goes into social welfare spending. So government spending as a share of GDP in Brazil is very high, but it is very little on infrastructure. Now, subsequently, if you look at the case of Russia, a decade ago, the break-even price in Russia's budget for oil was $20 a barrel. Today, at $110 a barrel, Russia's budget does not balance. So what we see is that a lot of incremental spending in Russia has gone on welfare spending, and today its budget is quite stretched, and its economic growth rate has slowed down to just 2% this year. Briefly on India, before I sort of finish my demolition job of the BRICS and move on to which are going to be the next breakout nations. As you can see in India's case, its growth rate has been very linked to the global economy. Its rankings of the 150 economies we track has been remarkably stable, which is India's ranking has been about 24, 25 of 150 countries, partly because its income level is so low, so there's ample scope for catch-up. But it is, India's trajectory has been very global in terms of its growth rate. The simple rule for India's growth rate is whatever is the emerging market average, add about 1 to 1.5%, and you get India's growth rate. But in India's case, one of the big problems has been inflation. As you can see, there's been a remarkable deterioration in India's inflation rankings over the past few years. That of the 150 odd economies in the world, India now ranks in the bottom quartile of its inflation rankings after having an inflation rate that was much better than the global average for many years. So in emerging markets, what's happening is this, that last decade, we saw this synchronous boom where every single emerging market did very well. In fact, in 2007, there were only 3 economies in the world which reported a negative GDP growth rate. Typically, in any year, about 15 to 20 economies at least report a negative GDP growth rate. In 2007, only 3 did. Fiji, Zimbabwe, and Congo. Basically, who cares, right? So the whole world was booming, and we had this massive boom in emerging markets where the rising tide of global liquidity was lifting all these countries together. Now the tide is running out, and emerging market growth rates are slowing down to their old normal of about 4% or so. Ex-China, though, this number is closer to 2.5% to 3%. So this is a major slowdown taking place across all emerging markets for some very fundamental reasons. And those fundamental reasons really are the fact that export growth in all these emerging markets is slowing down, and capital flows to emerging markets are now not doing too well. So as you can see, export growth has come off a lot after last decade, and capital flows too have come off a lot in terms of the last decade's very strong capital flows to emerging markets. Always an issue with the ticker. Let's try to get this going. So the concept that I try and sort of lay out here then is that if all these economies are slowing down, which are the economies that are going to do well in the subsequent years? Because that's really the global growth game, which is that it's very hard to sustain economic growth for a long period of time. As you can see here, that in any particular decade, only about 1/3 of the economies in the world are able to grow at 5% or more. The odds that those same economies can sustain these high growth rates for 2 decades or 3 decades goes down. Only 6 economies in the world have been able to sustain an economic growth rate of 5% or more for 4 decades in a row, and only 2 have done so for 5 decades in a row, and those 2 being Korea and Taiwan. The economies that I call the gold medalists of growth. And this really is because most economies are stuck in this circle of life. And the circle of life really is that economies tend to have an economic boom, but that economic boom then leads to complacency. That complacency sows the seeds for crises, and most economies only reform in a crisis mode when their backs to the wall. So therefore, we have this phenomena where there are 150 odd emerging markets in the world and only 35 developed economies. And many of these emerging economies from Brazil to Mexico have been emerging forever, so that they're not able to break out of this circle. Because very few countries reform in good times. and they wait for crises to come when they've lost the economic advantage to reform. In fact, I think the Indonesian finance minister had a very good line about this, saying that good times make for bad policy. And I think that's what happens, that bad times conversely make for good policy. Now, I'll go through a few rules of the road that I look at in terms of what to look at as to when an economy may do well or may not do well. Now, this is one of my favorite rules to do with politics. Typically, what we see is that the first term of a new government is the best time for economic reforms in a country. And we get diminishing returns of power if a leader stays in power for a decade or more. So it's very interesting that if you look at the incidence of protests this year, which have taken place over the last couple of years across the emerging world, they've almost all taken place where the ruling party or the ruling leader has been in power for a decade or more. And the best reforms are taking place in countries that have elected new leaders. So, good time to invest in a country or to engage in a country's economic growth rate is when there's new leadership that comes into place. In countries where the leader's been in place for, in power for a decade or more, you typically get diminishing returns for power. And here's the other rule that I find very important. People ask me that is there any way that you can predict crises? I say my favorite rule is credit growth, which is that when any country extends too much credit in a short span of time, that almost always leads to trouble. And that's one of the sort of issues I think the Chinese government today is grappling with, which is that if you look at what's happened in China, that the last 5 years, China's debt to GDP has increased by 60 percentage points. This is unprecedented. And to sustain a higher and higher economic growth, China is being forced to take on more and more debt. To put this in numbers, 5 years ago, it took $1 of debt to generate $1 of GDP growth in China. Today, it's taking $4 of debt to generate $1 of GDP growth in China. And that's something which we are obviously concerned about. Here's a more fun rule, that following the list of billionaires on the Forbes list is usually something that we do for voyeuristic pleasure. But in fact, there's some economic meaning as well to this, that if a country has too many billionaires relative to its economic size, that's not a good sign. Or if a country has like too many billionaires coming from the wrong sectors, which is like just sectors which rely on government contracts, that's not a good sign. And you also need increased churn, which is that you need new billionaires to come up rather than just the old billionaires to keep featuring on the list. In this regard, the countries that don't score that well include Russia, Malaysia, India, Mexico. And the countries that score quite well, in fact, include the likes of China, Japan, Korea, where you see many new billionaires come up. You don't see the billionaires coming up in the so-called wrong sectors that often, and also the fact that as a share of the overall economy, that's not too high. So that's another rule to look at. The other rule is manufacturing, that every single economic boom in history has been sustained by manufacturing. This is the heart at the boom of any economy. And here what we see is that this is where East Asia is really competitive and why the likes of Thailand still look quite good. Of course, China's manufacturing prowess we know about quite well. But the real problem is to do with these other countries, as you can see, that the likes of Russia, India, Brazil, South Africa, where manufacturing as a share of GDP is very low. Then what I call the helicopter rule, which is investments as a share of GDP. And the reason I call this the helicopter rule is a bit intriguing, which is that whenever I go to Brazil, I always feel like James Bond. And the reason for that is that I go to Sao Paulo, and if I'm running late for a meeting in Sao Paulo, the advice that I get from the CEO is, come to my rooftop, here's my helicopter, that'll take you from one building to another. So basically, you can completely sort of get past the road infrastructure if you are a rich enough person. But that's the bad thing for the country, because for the country it means that not enough investments going on, and the top people are just busy sort of flitting from one building to another in a helicopter. So you need high investment to GDP to sustain high economic growth rates. And of course, you need it to be productive, but you need high investment to GDP. So just coming to the end of this session of my presentation, which is that which are the countries, when I use some of these rules, that I think can be the breakout stars of this decade. Well, the countries that I like here include Philippines, Thailand, Colombia, Peru, Mexico, Poland, as just some examples. Now, many of these countries, especially here in East Asia, you can see have some common factors. The likes of Philippines and Thailand didn't do well last decade, but now their chance is coming because they've got new political leadership, which has done something to at least bring about some political stability in the case of Thailand, or in the case of Philippines, to actually carry out a fairly meaningful reform agenda. Now, things take time to change, but at least it's moving in the right direction. Colombia and Peru, the good news about these countries compared to the likes of, let's say, Brazil, is that they've used the commodity windfall to make a lot of investments. So investment to GDP in these countries is increasing, unlike in Brazil, where like the entire commodity windfall was used in consumption expenditure. Mexico, also new political leader carrying out economic reforms, so we're likely to see an increase in Mexico's growth rate. And Poland is really the solid country of Eastern Europe with very good fundamentals, which is likely to benefit from the fact that Europe finally seems to be exiting its recession. So briefly, as you can see, that Philippines was really the joke of the region for many decades, and this is the problem with long-term forecasts. As you know, in the 1960s, people thought that the stars of East Asia, the IMF World Bank projections, were that the stars of East Asia would be Philippines, Burma, and Sri Lanka. We know what happened to that forecast. So Philippines was a basket case for about 3-4 decades. Now we're seeing signs that Philippines' investment to GDP is picking up. In Thailand, I think that the big competitive advantage has to do with its manufacturing sector. That manufacturing in Thailand has been increasing and is the second highest in the world of any country at about 30%. And both Philippines and Thailand are benefiting a lot now from the fact that wages in China are going up. And the increase in wages in China sort of shifts the competitive advantage to some of these economies. In the case of Mexico, as I said, that we have a new political leader, and manufacturing as a share of GDP in Mexico currently is 18%. That's the highest for any economy in Latin America. The big problem of economies in both Latin America and in Africa has been that manufacturing as a share of GDP in these economies has been rather low. And that is really a problem for those economies, whereas Mexico, manufacturing has been higher, and now the wages are much more competitive out there. If I can just get this going. As I said, in Thailand, that manufacturing is relatively high as a share of GDP. And as you can see here, that both these countries are gaining on China in terms of their wages. Poland's fundamentals look good because its costs are quite low, its currency is quite flexible. Mexico, I just spoke about as to why it's the best story in Latin America currently, because its manufacturing is showing some signs of coming back after losing ground to China incredibly over the last decade, because wages in Mexico, as you can see, have now converged with that of China after being far higher than China a decade ago, as Chinese wages have been going up. In Latin America, it really, like the Andes run through the center of Latin America, and my sort of rule about Latin America, left side good, right side bad. So like left side, you have the countries which are doing well, Chile, Colombia, Peru. Right side, Venezuela, Argentina, and possibly Brazil have been following a different economic model with much more sort of wasteful spending and not much in terms of new infrastructure or new investments. So this is what I said, that the commodity windfalls were used to boost investments in these countries, as you can see in Peru, Chile, Colombia, and not in the likes of Brazil and Venezuela. So in summary here, the winners of one decade are rarely the winners of the next. This is what makes the global growth game so dynamic and impermanent. And so we always need to be on the lookout as to which are going to be the winners of the subsequent decade, and to sort of take it that if countries have done very well for a decade, the odds are, not everyone, but the odds are that those countries will not do well in the subsequent decade. What we're seeing now is that all the BRIC nations are running into some domestic structural problems of their own. These are particularly more severe in countries ex-China, such as Brazil, Russia, South Africa, and even India. This decade will be defined, I think, by a return to more normal growth rates in emerging markets, which is some will converge, some will not converge. As these BRIC economies fade, new breakout stars will emerge. So we need to be nimble, keep a lookout as to what the various rules of the road are in changing our assessment. Like 2 countries, since I wrote the book on which I've had to revise my assessment already, are Indonesia and Turkey. In Turkey's case, partly because you've had a political leader now who I think is overstaying his welcome in power after being in place for a decade and doing a lot to reform that country. And in like Indonesia's case now, we have to wait for the new political cycle to come before we see a fresh impetus towards reform that Indonesia badly needs. So this is not the end of the high growth period for emerging markets. The developing world still represents a very sizable portion of the global economy. It just is that we are now like in an era of differentiation, where some countries will do well, some will not do that well. And in this area of differentiation, we have to pick out the winners and losers and be very active about changing our preferences rather than sticking to very long-term forecasts which are not practical and likely to be wrong. Thank you.
Thank you very much. Mr. Ruchir will take a seat on the stage, and to join him for our 11th session, our panelists, and back to our moderator, Dr. Timothy Yong.
Ladies and gentlemen, we now go into the open forum discussion part of this session. Ruchir Sharma makes the point that economies that have done well in the last decade are unlikely to be the economies to watch out for in the following decade. I noticed that in his slide on economies to watch, in the next decade, he doesn't have Indonesia, and he doesn't have China. So I think it would be good now to have an Indonesian view on this. Ibu Karen, as the head of the largest company in Indonesia, and as someone who has played a key role in the economic development of this country, what is your perspective on this? Do you see Indonesia as a breakout nation? If so, why? If not, why not?
Thank you, Timothy. I think I'm here to change the Ruchir Sharma's perception on leaving out Indonesia to be a breakout nation. And one of the definition of a breakout session is that the country can grow faster compared to other countries per income commodity. Now, if you read the Asian Development Bank's report, that they argue that there are only some countries that can sustain the high growth for 10 to 20 years. And that is because 2 factors. It's because of political stability, it's because of governance, and it's because of policy failures. Now, and they are considered to be the middle income trap. And it will be very expensive if you have reached those 2 decades and get stuck in the middle income trap, because you don't have the right skills, you don't have the right innovations, and you don't have the right management excellence. So if you ask me, what does it take for Indonesia to be a breakout nation? I see that Indonesia will have a more difficult time, or should I say challenge, to become a breakout nation, because the global economic growth is now more modest. And of course, emerging countries need to reduce their growth expectations as well. But I do like Ruchir's definition that there is no rule for a general rule for a nation breakout. And he said that if the leadership in Indonesia slips and strives to create a family dynasty like Argentina, the country could quickly lose its momentum. And I do agree with you in that sense. But I still see that Indonesia can be a breakout nation due to 4 facts. One is because Indonesia has improved its governance. It has handled the transfer of power from one rival party to another in a so-called calmly way. And the democracy has been tested into several tests, like the terrorism, the tsunami. So for me, I think a tried and a tested democracy is a factor that can help deliver the economic breakout. Number 2 is, I think Indonesia has been gradually accelerating the economic growth, around 6%. And number 3 is the economy is very highly open and being deregulated. And I do hope that with the Asian economic community, there will be other Indonesian companies to keep up moving the value chain to compete with the likes of China and India. And the last thing is that the country is more resilient in stocks, and also before it was thrown off in 1997 and 1998. I think the macroeconomy is more stable, and the banking sector is also much stronger. But those are the good factors that we have in Indonesia. What needs to be improved is the infrastructure remains very poor. Business environment remains poor. If you look, and this is because of the corruption problem. The World Bank's report, in 2007, we are ranked 143. We have moved to 118, but that's not enough. It is still at a poor level, though the direction is already improved. And the competitiveness needs to be improved as well. In the World Economic Forum, we were ranked 17 for best manufacturing. And although in 2010, Indonesia was unranked. And on the Logistic Performance Index, it has moved from the 75th rank in 2010 to the 59th rank in 2012. So if we can overcome these challenges, I think we can be a breakout nation. Thank you.
Thank you. So Indonesia can be a breakout nation, but there are some conditions attached. I think it's useful to turn to look at China. According to Ruchir's presentation, the forecast for China over the next decade is 5–6%. Now, 5–6% is a wonderful rate of growth for most economies, but certainly not for China. There is a lot of talk now about China needing to move from an investment-driven economy to a consumption-driven economy. Will this have a major impact on the growth rate? Will it work? Do you agree with the forecast? 5–6%. That's the lowest number I have heard for a long time. Do you share that view? Kevin.
Thank you, Tim, for that question. After I heard Ruchir's presentation, I changed my talking points. I was originally planning to make one, and now I have to make 3 points on China. Maybe let me start with your question, Tim, on the issue of economic rebalancing, investment versus consumption. Right? People are talking about that for the last 2 or 3 years. I think the general gist you get from the Western media and Western economists is that China used to have this investment and export-driven model. Now that model has running out of steam. You need to really switch it off to another model, which is driven by domestic consumptions. Okay, that view, in my opinion, is misguided for 2 reasons. One is that view is based on an argument that the marginal economic return of additional investment is low. Right? So because China has made all this investment, if you throw more money at that, it will not return as much as it did before. Again, that view, in my view, is misguided because if you look at the capital in terms of per capita capital stock of China today, even after 35 years of heavy investment, heavy development, it's still very, very low. Even compared to middle-income East Asian countries, the capital stock per capita of China is 40% lower. And if you compare to the United States, China's per capita capital stock is 10%. Right? So the idea here is that the capital accumulation process that China has been going through for the last 35 years can continue through investments. And those investments, if you select them properly, will continue to generate returns. That's the first point on that. The second point is the flip side, right? What about consumption? People think, why don't we just switch to household consumption and then China will become a consumption-driven economy. That is also an incorrect sort of perception. The mathematics are very simple, right? If you look at the past 35 years, the average GDP growth of China is roughly 10%, give or take. And if you look at the consumption, it has been growing about 8% a year, right? So when you have GDP growth at 10 and consumption growing at 8, obviously over the long run, the share of consumption is becoming lower and lower. So that's why that number in terms of a share of GDP of consumption in the 80s was about mid-50, 55, 56%. Today it's about 35, 36%, because that 10%, 8% differential accumulated over the number of years, right? So the point is that if you want to reverse that, right, what has to happen? Number one, the GDP growth is already coming down to 7 to 8%, okay? But even that level, unless you dramatically increase your consumption, the share of consumption GDP will not change dramatically. So that's why I think this rebalancing, some sort of immediate switch on, switch off type of rebalancing is not happening, right? Which leads to one of my conclusions is that, what's happening in China today is certainly towards consumption, a little bit away from investment, but it's a very long process. China is not going to a different development model. It's an upgraded model. It's probably a better model to move towards that direction, but we're not going through a risk of going to some entirely different consumption-driven model. It's like China has been playing ping pong for 35 years. They play that very well. They're not going to switch to play tennis tomorrow. They may make the ping pong ball a little bigger, the platform a little bigger, but they're not switching. So the risk of that abrupt switch is very, very low. Therefore, I'm actually quite bullish that China will continue to be on a growth trajectory, right? Quickly, 2 other points, just to challenge Ruchir a little bit. The first is your comment on debt. I think the last couple of years, there are quite a few Western economists are really looking at the debt problem in China. The number does look negative. But if you look at China in the last 10 years, right, people have been worried about the ghost towns. 10, 12 years ago, Pudong was named as the biggest ghost town of China. And if you go to Shanghai today, look at what Pudong looks like. And then more recently, People worry about the banking crisis in China in terms of the bad loans, and actually the government in the end cleaned up it very swiftly. So the point I'm making here is that it's not like there is no debt problem. I think there is a debt problem. The question is that, do we think the Chinese government, with the help from the private sector, have a way to solve that, right? Do they have a way to solve that? The way I see it is, if you look at the government side, right? If you compare the Chinese government with the traditional Western government from a financial side, what's the biggest difference, right? If you're a Western government, if you're a United States government, in the financial sense, your biggest thing is you collect taxes, okay? But in China, the Chinese government not only collects taxes, it owns all those large state enterprises. Many of them are in monopoly situations, so that generates a big additional income for the government to deploy. And finally, the government owns all the land, right? So this is a very different. If you look from a Western lenses, only a tax collecting authority, then the debt problem is very hard to resolve. But if you look at it in the Chinese context, that the Chinese government collects taxes, own the SOEs, own the land, it has a far deeper pocket to solve that problem, right? Finally, my last point, which is also about Ruchir's point about how many countries can grow in a fast manner over a long period of time, right, 3-4 decades. I think the key here is one word, really, is about adaptability. I think any economic model that doesn't adapt itself will not grow for 20, 30, 40 years. Okay, so the key question on China is, do we think China today has an economic and political system that can adapt itself to whatever new challenges that is coming, right? Which also linked to Minister Basri's point yesterday about the intangible assets, what he called, right? The soft sort of political governance system. Is the system in China today is conducive to solving economic challenges, or is it a problem, right? The interesting thing, obviously, in China today is you do actually compare to the United States, you do see long-term vision, long-term even government tenor, right? And you do see state capacity to do what they want to do, to execute. You do see a system of plenty of feedback loops in terms of getting what works, what doesn't work, how do you adapt to that, how do you expand certain policies. So that all these elements points to me that China actually has a very adaptable system. It's not a traditional electoral democracy to get the feedback from the voters. It's not a traditional market economy. You get the feedback from the markets, but it's a very adaptable system that may allow itself to increase the chance to solve some of the problem and continue to grow its economy. Thank you, Tim.
Thank you very much. But 5 to 6%, Kevin?
My personal view, actually, the World Bank today, this morning, we just issued our East Asia economic updates where we predicted 7.5 for this year and 7.7 for next year. 5 to 6 sounds low to me, but as Ruchir said, there's no way you can predict those numbers. But my personal expectation is by 2030, China will be the high-income country. And it has many challenges, right? Income disparity, environment, and many others. But China will be a high-income country by 2030.
Thank you very much, Kevin. Pierre, you have flown a long way to be at this meeting.
Yeah.
You've come from Ottawa.
Yes.
You drive Canada's export development. An important part of the world for you are the emerging markets. So when you look at the emerging markets, what do you see? What do you see as driving growth? What do you see as impeding growth?
All right. Thank you, Timothy. Let me be clear. I'm not a quant analyst, and I will not challenge Ruchir on all the slides that he's presented. I'm the president of Export Development Canada. Last year, we supported in excess of $87 billion of business. About a third of that is in emerging markets. So what I wanted to do today is just to share with you a down-in-the-weed business day-to-day perspective in terms of what's the outlook for the emerging markets, obviously from a Canadian perspective. For Canada, and this is talking with the business people, the The biggest opportunity in terms of the emerging market is here in the Asia-Pacific region, for two reasons that were actually discussed yesterday and today. The first one being the need for infrastructure. Several times we've heard that concept before. We're talking about energy, transportation, road, telecommunication, so on, so on, so on. The second element that is at the back of the mind of all the business people in Canada is the middle market. It's booming. It creates consumption, it creates demand, new market, okay? There's a third element as well, as there's been a shift in the last 10 years in terms of the pattern in trade. In the last 10 years, north-south trade increased roughly by maybe 10-15%, whereby south-south roughly 20% a year. So essentially, from a Canadian perspective, we see Asia-Pacific as an area where we can grow the footprint, where we can have the biggest opportunity for Canadian people. It's not going to be easy. There are roadblocks, okay? The trade world is very integrated. What's happening in the developed market will obviously impact the emerging market. When U.S. get a cold, we feel it. We all feel it. The world, the trade is slowing down. It's impacted the region here, obviously. However, when we talk to our companies in Canada and we sit down with them and look at our future, the next 3 years, 5 years, we are of the view that our emerging market support will grow anywhere between 5 or 6% over the next 5 years. This is what I would call is our more realistic kind of approach. Some days we think it'll go back to normal, 3, 4, 5 years down the road to higher growth. But for now, we're saying, from our Canadian perspective, we're saying the growth rate is expected to be around a 5 or 6%. We follow the situation very, very, very carefully. We think there's value for Canadian companies, but I would say also that the concepts of what I just discussed are also valid for other countries. So for us, growth, Asian Pacific, we see this as modest growth temporarily, but hopefully we'll be back to normal sooner than later. So I do have to say that I contradict a little bit what Ruchir just pointed out in his initial remarks. However, I'll just say to you that this is just coming from business people interacting in about 180 countries in the world. But essentially, we've supported in excess of 30 billion of business in emerging markets, and we expect that to grow significantly over the next few years.
Thank you, Pierre. When I was listening to Ibu Karen and Kevin's comments, Ruchir, it suddenly occurred to me that one of your rules for the road is that the best time for reform is when there's new leadership, the first term. Well, in the case of Indonesia, there will be new leadership next year. In the case of China, there is new leadership as we speak. President Xi Jinping will be addressing this summit in a little while. So does it follow from your rule of the road that this is actually a time when we can expect reforms in both these countries and time to take a closer look because it would seem from your comparative analysis that this is the most fertile time for positive change?
Yeah, no, I mean, that's a great question. I think, just a point here. When I wrote the book, in fact, Indonesia was one of my breakout nations. And it's an economy that I do remain fundamentally positive on. Like its investment to GDP profile is like very good compared to other countries at above 30%, particularly compared to other sort of emerging markets and commodity producing countries. As I said, that my judgment on Indonesia today is suspended because of the fact that they have not, because the reform momentum in the last couple of years has really slowed down. They've been very dependent on foreign capital to try and fund their growth model. Inflation's been also creeping higher. So yes, if we get a new political leader after next year's election who seems to be sort of reformist, I think that is a good thing, but we have to wait to see because there are enough instances when you also get bad political leaders who take the country in the wrong direction. Like you get populists, we've seen this in Latin America or other places, you get populists who take the country in the wrong direction. So it's a question of who will be the political leader. Regarding China, as I said, that in China's case, what I'm saying is that China will follow the model of the other successful East Asian countries, which is Japan, Korea, Taiwan. And that is that once they became middle-income countries, their growth rates slowed down to 5 to 6%. It just is the anchoring bias of people that a slowdown to 5 to 6% is seen as a mini catastrophe because expectations have been so high. So, but my forecast is that over the next 5 to 10 years, China's growth rate will be 5 to 6%. And that is the most successful economies in the world achieved that growth rate after they got to a middle income country. If I was really bearish on China, my forecast for China would be 2% growth or something, which is basically no more convergence with the developed world. So it's a sort of thing that, but so many people are wedded to 7 to 8%. From where they get this number 7 to 8% is beyond me. It's because it's the government's target and it must be achieved by 2020 or something. But those are old targets. The government, I'd say the single most important thing that China needs to do, if you were to ask me today, is to revise this target, which is that because you're forced to grow at a target which is above your potential currently, you're taking on more and more debt to achieve a target that is unsustainable. So if you were to have a lower target, you would possibly get to your final destination in better shape, as that traffic sign goes, that better to arrive late than never.
Thank you very much. I'm going to invite 3 questions, one from that end, one from the middle, and one from the right. So if you have a question, any questions? Gentleman over there, please identify yourself. Please identify yourself and.
This one?
Tan Sri Munir. Yep.
Thank you, Timothy. My name is Munir Majid. I'm chairman of Bank Muamalat in Malaysia. I think Sharma's analysis and presentation is bold and sweeping. I'm sure we all will not agree with everything that he had to say. But I think there's one gap in your presentation, and this is in respect of financial flows and crises. The advent of financial crises causing, economic disablement in many economies. And, if you look back at 97, 98, of course, and 08, 07, 08, and then, of course, the recent flows of capital out of emerging markets, they have a disablement component on the real economy. And I'm surprised that in your presentation, you did not highlight these flows and their consequences. And at the same time, you have actually not looked at Asian initiatives in trying to ensure sustained financing for some of their development efforts. Of course, it's early days, but there's been the announcement of setting up the infrastructure bank. There's been the Asian Bond Market Initiative, which has been in existence for a long period of time. There's a there is a corporate guarantee institution, which is just set up. Okay, it's only got about 700, 800 million of funds to guarantee the issuance of bonds by Asian companies which may not have a chance in the bigger bond market, with actually the rating done by Asian companies. So there are financial things that are happening in Asia, even if, and I must admit to this, there are international flows that affect emerging markets adversely. Thank you.
Thank you, Tan Sri Munir. I'm going to collect 2 more questions before turning back to the panel. A question, Professor Ken Morgan. Yeah.
Thank you very much, Dato Tim. Professor Ken Morgan from the University of Flinders in South Australia. When I look at where are the next breakout nations, there's one nation that has not been talked about that I believe is a breakout nation, where its top 200 corporations have about $3 trillion cash in the bank. In their pensions, they have $4 trillion. They're great innovators. They're now going to be exporting energy, and that's the United States of America. Would you agree that they are probably one of the next breakout nations, all taken there? This morning, there was a lot of talk about shale gas. Its impact, the United States will be emerging. Karen, do you see shale gas, particularly coming out of Canada, the United States, and China and other ways, is it a threat or is it actually positive? Threat being in short term, price cycles, but positive in that it will have long-term extension of your fields. Thank you very much, Dato.
Thank you very much. One more question from that end of the room, if there is one. Yes, gentleman over there. Yes.
This is Karosi from Newcomer Group, China. And I think other analysis based on the current situation. But you must understand that because APEC, such kind of big family relation, and most leaders are improving. So the current situation will change. I think the topic we should talk is how can help the slowly country to be more faster, and how to help the fast country to be more stable. So the economist people like Mr. Shahara should make another speech. And I think the beauty from Indonesia as a company should question, I want to question you, what is your prefer for such kind of APEC CEO summit? What as company we would like to get from such kind of government association companies summit? This is my question. Thank you.
Thank you very much. I'm going to invite Ruchir to respond to the two questions from Tan Sri Munir, and maybe you might want to comment on the point.
The breakout nation you wanted to know.
Yes, yeah, but just a quick response.
Quick,
I'm going to ask Ibu Karen to comment on the question relating to shale, yeah? And if any other members of the panel want to jump in, you're welcome to.
Right. So regarding your question about financial flows, I was told to keep my presentation strictly under half an hour, so I could not cover every single rule of the road. But as a financial investor, that is one criteria I look at very, very closely. And the rule we typically have is that if a country runs a current account deficit of more than 4 to 5% of GDP for 4 to 5 years, that is another sort of red mark for a country running into trouble. So I completely agree with you that looking at financial flows and their destabilizing effect on economic growth is extremely important. The good news today is that very few countries today are running such huge current account deficits in this region. With the exception of India and Indonesia, in the entire APEC community, there are few other countries running major current account deficits. So, so I'm not that concerned about it today, but it is something to definitely keep a lookout on, that if these countries don't correct their current account deficit to more sustained levels and keep relying on financial flows to fund their growth, it will lead to trouble in these countries, and that's destabilizing. But I think that that compared to 97, 98, there is no doubt that the region is much stronger. The short-term debt, everything else is much stronger. The only fault line is that the debt levels in terms of domestic debt are much higher, particularly in places such as China, and I've pointed that out as a fault line. But in terms of the region otherwise, and the initiative that you mentioned about, there's no doubt that the region today is in much better shape than 97, 98, so therefore I didn't go into that. But yes, looking at financial flows is a very important thing. And the other thing is that typically, but here's another rule of the road. I didn't have time to sort of go into this. Even in 97, 98, if you look at it, the first people to leave a country when there is trouble are not the foreign investors, but the domestic investors. The domestic investors have their nose to the ground. They know when trouble is coming. So even in Indonesia back in 97, 98, I was here in the East Asian financial crisis covering that, a lot of the domestic business people, domestic investors were the first ones to try and take money out of the country, and the foreign investors do it later. That is generally a rule that I tend to follow. So that's as far as that's concerned. Regarding your question about US as a breakout nation, I completely agree. In fact, when I first wrote the book was meant to cover the developing countries. Then I was, like when the new edition of the book came out, I wrote an epilogue in which I was told to extend the concept of breakout nations to the developed world. And there I did cite the United States as a breakout nation for some of the reasons you mentioned, and one very important reason which still goes sort of underappreciated, which is the fact that the largest spender on research and development in the world is the United States, which is that 1/3 of global R&D in the world is done in the United States. And you see that difference. For example, you look at a company such as Apple, the largest market cap company in the world today. It employs only 50,000 people. The people who make the products in places such as Taiwan employ more than 1 million people making the parts for Apple. But Apple's productivity is so high and its global franchise is so strong, and it's on the back of R&D. And I think that the research and development focus and the edge that the US has on technology is really underappreciated, and something which I think does make the US a potential for a breakout nation among the developed world. But you have to compare growth rates based on per capita income, because the US can never grow at 4 to 5% because it's a developed country. But can the US grow above the average growth rates of the other developed countries? I think the answer is yes, which makes it a potential for a breakout nation.
Thank you very much, Ibu Karen, on shale. And then I would like to ask Kevin whether you have similar thoughts on the United States as a breakout or comeback nation. But after that, I'm going to invite another 3 questions, starting from that end, over here, and over there. So if you have a question, raise your hands.
Before I answer whether shale gas is a threat to Indonesia, my questions will be to the US, actually. What is the US export policy on shale gas? And what is the total volume to be exported? And what is the total volume that is needed for the domestic demand? If I looked at Indonesia, it has great potentials of gas, and we have one huge asset which is yet to be developed because of the high investment and also high technology that is required. But there is a rule of $12, which is presented by a consultant, Feridun Saragi. Shale gas may be cheap at the Henry Hub, but you need to take account of the liquefaction and also the transportation side. And at the end, it will converge to $12. And it is the same as, developing an asset as complicated as Natuna, with an investment of around 30 billion. And so I don't see that, shale gas will be a threat to Indonesia unless we don't get our act fast enough to develop Natuna. Because if you miss that one cycle, you will miss for the next 20 years. Thank you.
Thank you. Kevin, a quick comment on whether you have that same optimism about the United States?
I think I personally think there are a number of reasons you can be optimistic about the United States. I lived there for almost 20 years. Fundamentally, if you look at things that a country needs to do well, that it does have political and economic stability, usually in most of the days. And it does continue to have a number of economic drivers. I think innovation and R&D, as Ruchir mentioned, one of them. I think on the worrisome side is really the ability, as I mentioned, which on the China side, the Chinese government does adapt. The US government does not seem to be able to adapt, right? And in terms of time horizon, the politicians in the United States live for 2 or 3 years of election cycle, or what they look like on TV tomorrow, or the next fundraising event. It's very hard for them to have that long-term horizon. Therefore, on the political side, they may be making suboptimal decisions. So that's my worry. But there are reasons to be optimistic about the United States.
And Timothy, I just want to mention to you that, I mean, we cannot overlook U.S. It's an important trade partner for Canada. And we do share also the same kind of a positive sentiment for the same reasons that were explained here. So,
thank you very much. Two quick comments from the floor before we start wrapping up. Are there two quick comments, questions? Yes.
Break.
Over there.
Hi, I'm Scarlett Chang from China.
Can you speak a bit louder? Identify yourself, yeah.
It's worked. I'm Scarlett Chang from Beijing, and I'm from Metro Exchange. I have some questions about Shanghai Free Trade Zone. May I have your comments, Mr. Sharma and Mr. Lu? Do you have some comments with the Shanghai Free Trade Zone? Even there is not enough details for the policy, not right yet. And do you think it's a big challenge to the foreigners to invest in China, or there is a big challenge to Singapore and Hong Kong?
Another question before we return to the panel? Yes.
Thank you. I'm Major Frega Wenas from the Indonesian military delegation. I would like to address my question to Mr. Sharma. The emergence of new potential market in some region, to some extent, has stimulated the flow of people, which also influence in creating a more diverse population. In regard with this issue, I would like to know your perspective on the influence of diversity and size of population in contributing in becoming a breakout nation. Thank you.
Thank you very much. You want to quickly respond?
Exactly. Just very briefly, I think that the Shanghai free trade zone sort of rhetoric so far is very positive. It shows that China is willing to sort of keep opening up, keep reforming. The good thing about China, which I sort of didn't mention in the presentation, is the fact that China has historically been able to carry out economic reforms even in good times. So it's not always waited for an economic crisis to hit it before carrying out economic reforms, which is what most emerging markets do. But having said that, the details of this are still quite sketchy. We don't know enough about this, but it definitely sounds like a positive thing to do. And I don't believe that it's a zero-sum policy that will hurt Hong Kong, Singapore, because of the fact is that the more such trading centers, the more such free trade zones we have in the world, the better it is for the global economy. And it's only natural that, given China's size, that something like this comes out of China. In China, my main concern, as I said, just remains the fact that the growth target is very ambitious, and that needs to be tweaked in terms of, rather than the level of debt that they're piling up at a very aggressive pace, especially in the last 5 years. This was not the case 3-4 years ago. This has changed post the 2009 stimulus. Regarding the question about population, you said, in terms of the impact that it can have, my entire concept of breakout nations is that let's stick to a reasonable time frame, which is about 5 to 10 years. And I think over 5 to 10 years, that thing does not really have much of an impact. It has an impact over much longer time frames than over the kind of time frame that you're speaking about. But I think that this has been one of Japan's major pitfalls, as we know, that in Japan's case, they also spend a lot on R&D, but the entire R&D goes into the domestic market and not enough of it goes into catering to the global marketplace. So having a sort of diverse population, much more, friendly immigration policies definitely helps you make you more globally competitive. But these are very long-term sort of things which happen, like education, and not factors which influence growth rates, I think, over the kind of 5 to 10 year time frame that I'm speaking about.
Thank you very much. I'm going to start winding up the session, but what I'd like to do is to invite each of you to answer as briefly as you can. When we think of the future of emerging markets, what is the one most important thing that we should start in our minds when we think of the emerging markets? Because this is a time when there's a lot of uncertainty. There are different views. We know that the future will not be the same as the past. But what exactly is it going to be? So I'd like, as the concluding round to this discussion, if each of you would just share some quick thoughts on how we should think about emerging markets so that the people in this room, as part of this discussion, can have something to take away with them, apart from everything else we've discussed. Ibu Karen.
I think as a country, you need to identify your constraints.
Constraints, to be aware of your constraints. Kevin.
I think obviously there are many things you can think of for emerging market, and every country is different. For me, I think in the near term, the tangible things for all emerging markets is infrastructure. The importance of infrastructure development, the importance of getting them financed, and I think we can always talk about knowledge economy and other things, but infrastructure, physical, hard infrastructure, I think is still the name of the game. And let me add on that, for China, I think, which is related, I think the single keyword for me is urbanization. Because in the next number of years, there will be 500 million more Chinese people who are going to move from rural to the urban area, change their lifestyle, create economic demand as well as challenges. And if you look at the Chinese history, right, thousands of Chinese history, every dynasty is different, but there's one thing that is in common, is every dynasty in Chinese history ended because of the inability to solve the rural and urban problems. And I think that there's a real chance today that to actually, through urbanization, to solve that problem. I know this is very high on the Chinese leadership mind. In fact, the World Bank is working, as we speak, a major urbanization report together with the Development Research Center of the State Council. We're hoping to use urbanization as a lens to look at all the problems and challenges in China. So I think urbanization is this fundamental economic driver. It's the most important keyword for me to China.
Thank you, Kevin. Pierre.
Kevin read my mind. For me, emerging market is a code for infrastructure investment, infrastructure need. So everything that is related to it, you got to look at an opportunity. But essentially, it's infrastructure related.
Thank you.
Yeah, for me, the most important thing is to stop talking about emerging markets as a homogeneous entity. This is 40% of the global economy, and these are countries which are very diverse, with very different needs, with very different per capita income levels. You have India, Nigeria, which are still quite poor with a per capita income of only $1,500. You have countries like Korea, Taiwan, still called emerging markets, even though their per capita income is more than $20,000. Brazil and China, are so different from each other. So we'll have to speak about this as a homogeneous entity, but the real thing is about differentiation, that you have to differentiate between these countries. You can't talk about 40% of the global economy as a one single entity. That is just a wrong way of approaching this game.
And for me, as the moderator, it's two things. Firstly, the past is not necessarily the future. The breakout nations of the last decade are not necessarily the breakout nations of the next decade. And the next thing, which came through in the discussion, is that success is not guaranteed. Countries have to do the right things. They have, as Kevin put it, to relentlessly adapt. They have to avoid slipping into complacency, as Ruchir reminds us. And as Ibu Karen mentioned in her conditions for Indonesia to continue to be a breakout nation. Ladies and gentlemen, thank you very much for being here on this Monday afternoon. Join me in thanking our wonderful panel.
Thank you very much, Dato'. Thank you to our speakers as we close out our 11th session.